Hello there, everyone. This is Mitch. Okay, just want to make sure I got my graphic in there. Hello, everyone. This is Mitch Goldberg with Be the Boss of Your Money. Welcome to the podcast where you learn about personal finance, investing tips, business, and other very important subject matter that is related to the above matters. It's an important topic today. We're going to talk about the anniversary of the demise, the collapse of the storied investment bank called Lehman Brothers. You know, when I got into the business, when I sound like such an old man, when I got into the business, we had one shoe and we had to shit. No, when I got into the business, Lehman was just the creme de la creme of firms that you could work at. I mean, no one knew more about bonds than Lehman. Who would know more about bonds than Lehman? I mean, it was a storied name. Unfortunately, the housing market came around in the 2000s. It got carried away. Too much debt, not enough, weak lending standards. The point is, Lehman went under, and it literally brought the U.S. economy to its knees. And there were a lot of lessons learned because that's when the Federal Reserve started with their unique policies. Let's call it that. The whole quantitative easing, zero bound or near zero bound interest rates, and all these lending and credit facilities. And it was amazing to see what happened. It happened very quickly. I literally, I owned my own firm, Client First Strategy, even back then. And it was just a crazy, crazy time. I mean, I remember saying to my wife, listen, the worry right now is not about me making any money. The worry is, the concern is, the goal is to get through this, however long it takes, to get through it in one piece, to bring my clients with me in one piece, to get client accounts, clients' finances, their personal finance, their plans, their goals, to get them through this time. That's the goal. And if I do that well, this will prove my mettle better than anything else. And I'm here. I survived. I lived to tell the tale. So we got through it, and we're through something. We're going through something now, which I think is worse. This whole pandemic. Lehman was horrible when it went out, but people weren't dying from a disease. It was a tough time then. I think it's tougher now. What we're going to talk about are lessons from back in that day, and just a few things that are going forward. We'll talk about the Federal Reserve, the Treasury, politics a little bit. I'll just get into it because I think it's important that you have some kind of context of what the playbook is that the financial authorities in this country are going by. There's an old expression that central bankers are always fighting the last war, meaning they use whatever tools that they used that got them through the last crisis for the new crisis. But if it's a new crisis, the same old tools don't work. And I think the tools that the government is using now are helping. But the problem is, when you take away the tools, we go right back into a swoon again. So that's what we're going to talk about. We're going to go through a quick update. That's what we do here. I give you a quick update of the market with some perspective, and I work in my lessons and all those good things. 30 plus years of doing this for a living, and I've written a ton of videos, ton of written content, and I know a lot, and I just want to share it with you. The idea here is be the boss of your money, is so that you're the boss of your money, not your money being the boss of you. The goal, to make you your best possible version of your financial self. So we're going to roll a quick intro, and then we're going to take it away. So stick around. This is going to be good. Lehman Brothers, pandemic, a lot of important things to talk about. Okay, and we are back. It is good to have you with us. So, what we're going to do is go through a quick update. This is what we do. This is how we do our thing. Hopefully, today will be better than yesterday. So, yesterday, can't believe I did this. I had this big, I have this cup of water. It's right now. It's about a third of the way full, and I have a Veridesk, standing Veridesk in front of me. And I always put the water on the top shelf. Been using this desk now for 5 years. Never had a problem. Never a single spill. And yesterday I was helping someone out. I had to move my webcam and pull the wire forward, and the water went all over the place. And it was like filled, almost to the top, all over my keyboard, all over my pants. It went underneath the very desk, just everything soaked. I was so pissed. It was like 4:26. I had 4 minutes until I would go live, until I had to go live. And I was like, oh, this stinks. And the keyboard wasn't working at all. And in fact, not was the keyboard working, I couldn't even open up my StreamYard service, which was what I used to go live. So I adapted real quick. I realized I could use StreamYard on my on a smartphone. So I just pulled it up on my smartphone, and I did yesterday's live stream from a smartphone. And that was really, really cool, because what it tells you is that I could actually take my gimbal. The gimbal is that thing that you see the YouTubers walk around with. It's like almost like an advanced selfie stick, but the phone faces you no matter where you turn. So I could actually go outside and do these lives. I could do them from my car. I could do them walking around Manhattan, which I think would be really cool and a lot of fun, and even take you to a live event. I'm really pumped up for this. So yesterday was a blessing in disguise. And what you also might not notice is I got a new keyboard. This is a Logitech keyboard, and it's wireless. And I didn't really want to get a new keyboard because I like the Microsoft ergonomic keyboard. This is ergonomic too. You see, it's got the split in the middle right here. See that? So I got a new keyboard. It works great. One less wire running across my desk. So I'm really happy with it. Oh, I thought we were going to talk about the market today. Yeah. Okay. So let's do that. I want to put my little brand recognition up here. Boom. You see that? There we go. Okay. So let's do a quick share screen, and then we're going to just get into the important matters today. By the way, I want to welcome all of you in the live stream. Thank you so much for watching. If you have any questions, hit me up in the comments. That's my favorite part, is when you talk to me through the comments. Words of encouragement are always appreciated. And if you're watching this in the live stream, I'd like to welcome you as well. I realize not everybody can watch these at 4:30 p.m. Eastern Standard Time. So if you're watching this in the replay, that's great. I thank you for your time, and certainly hit me up with questions, and I'll definitely get back to you. Okay, so let's do a share screen. The Dow is up over 230 points, but it only finished up 2 points on the day. I can't stand days like that, when you have these up 200, 300 point or more days, and then it's given back at the end of the day. That is, to me, never a is never a good sign. I have to tell you, it's not my office, it's intercom system. Okay. I have to tell you, I hate when that happens. It's never a good sign. And we have to take a look why. The S&P was up 17 points, up 0.5%. The Nasdaq had a decent day, up 1.2%. It's all tech related. The Russell 2000 was basically flat, up a point. The Russell 2000 are your small cap companies. They're a little bit more they're more sensitive to the domestic economy. They have less opportunities for financing from banks and the public markets. But the VIX here is coming down. The VIX, this is the fear gauge. The fear gauge says when it goes up, it says that professional investors are paying more to hedge their portfolios, so because they're worried. So this is good when it goes down. This is the one benchmark that I follow that you want to see go down, and it was down a little bit today. I said the line in the sand was 30. It was like 95 at the peak of the bear market that we had last March and April. And then it was around in the 30s. I said it had to go into 30 for this rally to be real. And it went into 30. The rally took off. And then I said, the new line in the sand is 25. We rose above 25. We hit the low 30s like a week ago. And now we're back down to just about 25. So if we could see this get solidly below 25, 21, 22, that kind of confirms that the S&P and NASDAQ rally are definitely, sticky, at least for a little while. What happened with the Dow? Well, here's what happened. First of all, Apple was up nicely all day. They announced new products. I'm not going to get into that now. You can read up on that for yourself. But Apple basically gave back almost all of its gains for the day. And, when techs lead, that's a big help for all the major averages. But the Dow Jones Industrial Average it's just not as, tech exposed as the, S&P and the NASDAQ. I don't know if I said that correctly. The Dow Jones Industrial Average is not as tech exposed as the S&P and the NASDAQ. I just have to say that you cannot invest directly into an index, but you could invest in a security that tracks or mimics an index. There is a difference. It's pretty subtle, but I have to say it. But Caterpillar was weak. All the financial stocks in the Dow Jones were down. JP Morgan, Travelers, Goldman Sachs, and American Express, they were all down. Financials were the worst performing part of the day. Let's take a look at the FANG stocks. Facebook, real good day. We want to see Facebook get back to 300, but still up a lot for the year, up $6 today. Apple, see, barely up 18 cents. Big whoop. Amazon up $53, decent day. Netflix, that was up pretty good, up 4%. We can't argue with that. Google up over 1%, almost 2%, and Facebook up 1.6%. So, I always say the FANG stocks are the heavyweights. When these stocks go up together, birds of a feather flock together. When these stocks go up, the whole market goes up. When these stocks go down, the whole market goes down as well. Anyway, we've got somebody out there. Nick is out there. Nick Nielsen. Hey, Nick, thank you very much. Keep up the great work, my friend. Thank you very much, my friend. I'm really glad you and I are connected, Nick. You just put out great content. Folks, if you're on LinkedIn and you're watching the show, connect with Nick Nielsen. He puts out such great content, and it's such like these bite-size, snackable content. He puts everything in a lot of his content in very easy to understand pictures and graphics, and it's just really great what he does. Great communication. Thank you, buddy. All right, so let's take a look here. The next one, the reopening stocks. Well, Planet Fitness was up. Cinemark Holdings, movie theaters were up. Delta was up. Southwest was up. Marriott Hotels was up. American Air was up. The ones that were off were just the cruises, Royal, Norwegian, and Carnival. They were off a little, I shouldn't say a little bit. They were off, but a lot of the reopening stocks were up. So mixed bag for reopening stocks, but you can see that it was really the tech stocks that took the day away. And lastly, this is the most important thing I look at, and I look at this a couple times a day. If you want a real quick snapshot, what you have here are the ETFs that represent the 11 sectors of the economy. And the winner was communication, which is about half Google and half Netflix. And then there's also, half Google and Facebook, and there's some Netflix in there too. I don't even know why it's an ETF with such a big concentration of two stocks, but whatever. Real estate was up, tech was up, but at the bottom of the heat were financials, energy, consumer staples were a little weak, and industrials. I always tell you this, industrials, that's the XLI, XLE Energy, XL Financials. You really want to see those leading the way to give you the feeling that we are in a stronger and sustainably stronger economy. Sometimes those sectors, sometimes they lead, but they don't hold on to their leads for more than a couple of days, maybe a week at most, and then they just give up the ghost. So financials were the weakest sector, and that to me is disconcerting. If you don't have financials participating in a rally, then my friends, I don't really think you have a rally that's trustworthy. Okay, so we're going to stop the share. We're going to get rid of the stop share screen. All right, so that's the deal for the market. Mixed bag overall. Not a bad day. We'd just like to see financials do better. So let's talk about Lehman Brothers. I'm going to tell you a little story. I've told the story to people who know me, but I've written about it. So here's what happened. I'll never forget where I was. It was July 15th of the summer of 2007. And I'm going to make this short. I was at an all day bachelor party, which was basically a day of golf. Fellow I know was invited, to his wedding, was invited to his bachelor party, and what he wanted was he had like 5 foursomes, and it was a great day. And at the end of the day, we had dinner, and it was all like meats and salamis and stuff, and wine, and it was just a great outing with the guys, and a bunch of my good friends were there. It was just a great time. So it was at this golf course, but after we finished our round, we all went into the locker room, washed up, and then came back out for dinner. And I just sat down on a couch in front of a big TV screen in the men's locker room, and the TV was on. So let me just get a quick update in the market. And it was like 4:15, and I remember Maria Bartiromo, who used to be called the Money Honey on CNBC. She's now with Fox, but she used to be a bigwig on CNBC, and she was talking about the market and the Dow. The Dow was on a really good hot streak through the summer, up to the summer of 2007. But that day, the Dow was off like 350 points, which at the time was a lot. 350 was a big down day. And she said real quick, just covering the news, going from story to story, and just real quick, she says, and two Bear Stearns hedge funds closed today. One marked 10 cents down to 10 cents in the dollar, and the other one marked down to 0 cents in the dollar. And while she was talking about it, they showed the brass revolving door that you've seen in the news before of the Bear Stearns building, people going in and out in the revolving door, going around in the Bear Stearns signage in brass above the doors. And that was it. That's all she said. And they just went on to the next story. And these she said these hedge funds are funds that invest in an asset class called subprime mortgages. And whatever, nobody really thought anything of it because nobody thought anything of it because it was just two hedge funds. They weren't like major hedge funds, but they did go down to zero. And that was it. But then you think, well, how can a hedge fund go down to zero? They must have been highly leveraged. They had to sell everything for whatever reason. They were in assets that went down a lot. But shortly after that, you started hearing troubles about subprime mortgage market. And heading into August, the market had like a 15-20% swoon. Scary and fast. It rallied right back into October, hit new highs, and we were off to the races until we got to the following March, when all of a sudden Bear Stearns was having trouble with an asset class called subprime mortgages. Anyway, that day in July, when I went to that golf outing bachelor party, that was the spark. Like that when those two hedge funds went under, that was the spark that told you the world was going to end financially. The economy would be brought to its knees. We didn't know it at the time. I mean, to this day, I am always looking for a spark, that signal that says, lights out, the market's over, raise cash, hunker down. It's going to be a nuclear winter. And, have I been right about any of those calls since then? No. I mean, every time I worry about something, the market has just steadily been in an uptrend for 11 years. And there are things that happen that help mitigate economic events. And those things were what came about when Lehman went under. And so Bear Stearns went under March. They were bailed out by JP Morgan for like $2 a share. It was like $180 stock at one time. And then Lehman went under in September, and the market 6 months later bottomed the following March of 2009. And that's when the Fed started taking extraordinary measures. Ben Bernanke, the Federal Reserve Chairman, said, we'll do whatever it takes to save the banking system and the economy. And the market's been up ever since, tremendously up. Tremendous. It's been up a lot. So, we look for signals all the time of like, what could be the big signal? For example, we have a pandemic going on, and we had the economic shutdown. And you'd think when in March we had a all-time high in the major averages in February, went down about 35-40% in the major averages in a couple of weeks. We've recovered, but you would think with everything going on, could there ever even be a spark that could bring the stock market down? Of course there is. These black swan events are things that we can't think of. If you could think of it, it's not a black swan event. Maybe you'll see the beginning of it, the telltale signs of something changing. I, for one, have been preaching in the show, hey, guys, it's time to take some profits off the table. Don't be so aggressive, rebalance, don't get greedy in the tech stocks. But now we're going through something else. And, we had the CARES Act, which was about $2.5 trillion. Okay. And that's what provided the $600 per week government funded unemployment benefit, and bailed out airlines, and just a massive bailout to get us hopefully through the pandemic. It helped, but now that stimulus is wearing off, we're starting to see some signs that certain parts of the economy are slowing down. But what can we learn from 2008 to get us through now? And I think the big takeaway is this: either you go big or don't do anything at all. When we were going through the Great Recession 11 years ago, we had something called TARP, Troubled Asset Relief Program. It was a $750 billion bailout program for the banks and some major corporations. Probably the United States actually made a lot of money from that program. It was actually very profitable to the U.S. Treasury. I don't know if you know that, but at the time, that was like mind-boggling how big that was. And now a $750 billion deal, like, you see what's happening in Congress now, $750 billion for the next stimulus. It's like the Republicans are at $1 trillion. The Democrats are at $3 trillion. There's a group of senators who they call themselves like the middle. They're trying to come up with something about $1.5 trillion. So $750 billion. It's not even in like our vocabulary anymore. That's how big these bailouts and rescue programs have become. But the problem back then was the TAR program, $750 billion, was rejected. The market swooned, and it prolonged the recession, the Great Recession, and it also hurt confidence. So we don't want that now. It was a very good confidence builder when the CARES Act was passed, and I think it'll be a real confidence destroyer if you don't get some kind of big program out. It doesn't have to be $3 trillion, but it's got to be somewhere in the middle between 1 and 3. So 1.5, $2 trillion. We could do it. Interest rates are low. We'll get the money. We'll take on the debt, but you can only take on the debt because foreigners are willing to buy, or will buy treasury securities. And even if the Fed buys the treasury securities and prints the money, ultimately it does add treasury security supply to the market. But, none of that has driven up interest rates yet. So there's plenty of room for the treasury market to absorb more treasury securities. So that's the big lesson. Don't do it piecemeal. You have to go big or go home. To me, that was the lesson from then that we have to use today. Now, there's something called moral hazard. Should we be doing any bailouts of the economy or banks? The problem is when you have a severe financial crisis, and every time we have a crisis now, it's a bigger crisis. I started in the industry in late '89, and we had a crisis. We had a real estate recession. It was a tough time. Manufacturing was gutted in the United States. Remember, Billy Joel came out with a song called Allentown, and we're working here in Allentown. I'm not going to sing for you, don't worry. But you remember the song? That was about the manufacturing of this country being sent overseas. But as big as that was, every crisis since then. Actually, I'm mixing it with the 81, 82 recession. Okay. Forget what I just said, the 81, 82 recession. But then the 1990 recession came around, and then the 2000 tech wreck, and then 2007, 2008, and now 2020. They all keep getting bigger. So I think what's happening is the Fed lowers rates. It creates more speculation. It creates bigger asset bubbles. It moves money from one sector to the other. We had the big bubble in crypto, Bitcoin, then in pot stocks. And I think we have it in a lot of tech stocks. That's why they've come down so hard in the last couple of weeks. And now money could move somewhere else. Money's moving into houses now, the real estate market, residential real estate market. And I think that's what is happening. The Fed, I think, should be out of the business of trying to engineer inflation and stick to what it could do, which is be the lender of last resort and the shock absorber for the U.S. economy, and as a regulator of the U.S. economy and the banking sector as well. So anyway, that's my story, and I'm sticking to it. And if you have any questions, hit me up in the comments. I would like to see the Congress go big with a big stimulus package. Yes, we are bailing out the economy. Is it a moral hazard? Yes. But look, here's what I want to say, and I'm going to wrap it up, okay? I promise I'll wrap it up after this. We have these big recessions, these big economic shocks now, and nobody wants to go through the pain. I mean, I don't want to be laid off. I don't want to lose my job. You don't want to lose your job. You don't want to see your income disappear. Maybe you're a residential real estate broker, or maybe you're a financial advisor. Maybe you work in a factory. Maybe you're a CPA. Maybe you're in the communication sector or healthcare. We don't want to suffer. We don't want to see our accounts go down. We don't want to see job losses if we could avoid them. And if there are job losses, we want to give people unemployment insurance. The idea is we want to make things as painless as possible. I don't think it's possible to have a painless recession. We want to save companies. As a result of low interest rates, of very low interest rates, you have a lot of zombie companies that can survive only because they could float a little more debt and a little more debt and a little more debt. And they can do that virtually forever because no one's ever going to call in the debt and say, I'm not lending you any more money. I actually want my money back. All right. So that's what's going on. I appreciate you watching. I'll be back tomorrow. I thought this whole thing with Lehman Brothers was fascinating at the time. I still do, but I am glad it is really a walk down memory lane at this point. I'll speak with you soon. Thank you.